G'day folks, welcome back to another update, and today we're looking at some currencies: the Aussie dollar, Aussie US, Euro, British pound, Euro US, British pound US, and US Japanese yen. We're going to include some back testing for each of these. Now, if you already haven't watched it, there's a +1 video I did some days ago. We tested these three strategies: the CCI14, the CCI350, and also the MA moving average 30, moving average 200, and the CCI150 strategies, comparing like for like. So go to the links in the description below to check that video out. Now, getting stuck into it in terms of the outlook for the currencies we're looking at today, the Aussie US, the outlook is cautiously optimistic for the Australian dollar, supported by rising commodity prices, notably iron ore and coal, and expectations of RBA rate stability, while lingering global growth fears and a stronger US dollar could cap gains. Euro British pound, the euro faces headwinds from the ECB rate cuts anticipated later this year, while the pound is relatively buoyed by somewhat firmer UK data, suggesting Euro British pound may drift lower toward parity. Euro US, the euro is under pressure as ECB dovishness contrasts with a resilient US economy and potential Fed rate hikes. The pair is likely to remain range-bound or slip modestly. The British pound US, sterling's outlook is balanced. Stronger UK fundamentals support it, but US yields and Fed policy remain key threats, likely keeping the pair in a tight range. US Japanese, the yen stays pressured as the Bank of Japan maintains ultra-loose policy, while US inflation and rate differentials favour the dollar, so US Japanese may gradually trend higher. So first, looking at the Aussie US, we always look at the long-term trends first. So here we've got the monthly, the weekly and the daily. Get an idea which way the higher time frame trends are directing. You can see here on the monthly, the price is still declining, although it's peaking. It's slightly above those moving averages on the price. Notice also the CCI has been declining, but also about to break through with a fresh breakout above the moving averages. So very cautiously bullish at the moment, very cautiously bullish on the monthly. On the weekly, you can see there it's already broken through those moving averages on the price as well as the CCI. So if you're trading on the daily, you would have started going long during those periods back there around about the 21st of April 2025. And also what we look at as well is for any bullish divergence, and looking at it here, from that low to that low versus the same period on the CCI. That's actually almost like a double bottom on the CCI, which I consider a bullish divergence, versus lower lows on the price, and that may possibly rise a lot higher from there. And if it did, we would draw a Fibonacci range. Going back to that level, you can see it's already broken through the minimum ranges, the 38% range. That's a minimum pullback. It's already done that. So I don't trade those divergences. Look at it as a potential area to bounce as a retrace, in this case a bullish retrace. On the daily, we had, again, notice here we've got higher prices on the CCI versus a somewhat consolidation period on the CCI. So on the price it's moving higher, the CCI is dropping, and we could call that a bearish divergence. So just be cautious. We might see a bit of a pullback. We'll take it from that point there to there. So if that pulls back, we expect a 23-38% range as well, assuming it pulls back from where it is at the moment. It's also hitting this resistance at 66,249 and a minimum retrace, again, assuming it pulls back from where we are, will be in this little range here. So that's a minimum pullback. It could go a lot further. We take it one step at a time, see where it ends up. Again, this could go high if it does, or watch the CCI. If that breaks higher, then we'll invalidate the divergence, the bearish divergence. And again, I don't trade this. I just look at it if you're going long, start getting ready to exit your trades and taking your profits. Now, if we go to the 1 hour period, so even if you're trading on the daily, we look at the 1 hour for any micro moves. You can see here, for example, we had a bearish divergence versus high highs on the price, hit that resistance. When it finally broke through those moving averages, that's where you would have closed out your trades, ideally at the very latest. And at the moment, it's still trending lower, although it's making a bit of a retrace to the upside on both the price and the CCI. So you might see a slight pullback, but I'd say predominantly bearish at the moment on the 1 hour time period. Also looking back here as well on a 1 hour period, we've got a double bottom on the CCI, slightly higher points versus lower lows on the price. That's a bullish divergence, you can see there. And that broke more than 100% retrace above that previous. If you had taken the Fibonacci back to that high, it's broken more than 100% past that range already. So always pay attention to these divergences. Now, in terms of a back test, what we've got here on the 1 hour time period, if would go in the direction of the daily. So you would have started taking long trades when the CCI and the price broke above the moving averages, and that equated to this period back here on the daily, on the 1 hour. The stop loss approach has generated so far about 1,647, and the average down has generated 21,000 approximately. You can see the stop loss approach with single trades, because we're stopping it out, take profit of 0.3% and close it out with a 0.5% stop loss. This one we take profit of a 0.3%, but instead of stopping it at 0.5%, we average down whenever the price retraces and add to the positions. Again, reference the links for the strategies on that one. So the Euro British Pound on the monthly, it's already broken above the moving averages on the price, as well as the CCI. Now those moving averages haven't started to bend up yet, but possibly looks like a bullish move at the moment, so you can trade long periods on the weekly if you're trading based on the monthly trend. On the weekly, it's already been bullish now for a number of weeks, as you can see. It's pulled back once and it's broken out above those moving averages again at that point there, and bullish momentum at the moment on the weekly. Also note back here we had a bullish divergence. Sometimes you've got to zoom out on these charts to get a better view. Back here, you could probably argue that was a bearish divergence back there from the same period. Bullish move on the price. That's broken down since as well. Now on the weekly, bullish divergence there. Finally broke above the moving averages on the price and broke higher. In this case, on the weekly, it broke, if you take it to that high, it broke up through the 61% and quickly retraced back and sort of leveled out a bit at the 50 and dropped back down to where it started from. So that divergence worked nicely. On where we are at the moment on the weekly, there is no divergence to worry about at the moment. That CCI is moving in line with the price, which is what we normally expect. On the daily, however, we've got this bearish divergence. So even if you're going long at the moment, be very cautious. I'd be watching this carefully and getting ready to exit the trade as soon as you see that price come back towards that moving average, especially if it breaks into that range. Now, if we go to the 1 hour chart, we look at the let's look at the naked chart first. So again, taking long trades from that period there. But first we look at the micro levels on the 1 hour time period. And what we look for is any divergence. And again, sometimes it's best to zoom out a bit. You can see here we've got lower highs on the CCI versus higher highs on the price. Going back to that level, even to that point, still higher highs, bearish divergence. So we're going to see a pullback at some point very shortly in the next few hours once the trade opens. Back here we had a bullish divergence that broke quite strongly, more than 100% through that Fibonacci range, and that's all it is for a moment. So again, be cautious both on the daily and the hourly. We're looking at a bearish divergence, so we might see a price pullback shortly. Now in terms of the back test, both the stop loss approach and the average down approach have been doing quite nicely because the price has been going in our favor. We started back here with around about the 30th of May when the price and the CCI on a daily broke higher above the moving averages. That's why you always look at the higher time frame to go in a direction. Back here you would have been going short during that period. For the Euro US on the monthly, it's very strongly bullish at the moment, above the moving average of the CCI and the price. So bullish momentum, and there's no bearish divergence to be concerned about on the monthly. On the weekly, likewise bullish. Had a couple of pullbacks here, and you would have closed out your trade on that candle there. On that, actually that one there. Once that CCI broke into that moving average range, then reopened it again on the candle afterward, the week after on that one there, if you're trading on the weekly, and getting close to closing out your trade as soon as that touches the moving average range of the CCI. That gives you the CCI touching the moving average gives you an earlier exit. Although you can stay in a trade here, but that gives you an earlier exit. In this case, if the CCI kept dropping, you would have been wise to get out of the trade. But no divergence at the moment on that. And there's zooming out just for history purposes, there's no divergence that I can see there. On the daily, we do have a bearish divergence. We've had a couple of them actually. So if I zoom in here for a moment, you can see here we had a smaller bearish divergence between those peaks there on the CCI versus higher highs on the price. I draw a target here, and that pulled back and hit the 23-38% range from that range there. If I took it back down to that low, that hit that 23-38% perfectly, then it bounced out of there. Sometimes it just touches that and bounces. Other times it falls right through, as we've already experienced. In this case, we've got another bearish divergence from that peak to that peak on the CCI, in the same range on the price. And we've drawn another 23-38% range there. Now, this one, where did I pull that Fibonacci back to that level? So it depends where you draw the Fibonacci. I've taken it back to that level there. But if I did it to this one, which is strictly where we should probably put it, it's really that little range there. And it's probably just, in fact, it's just touched it there. So it depends where you put it. You've got to be very strict with these Fibonacci's. I like to take them back to the significant low. This one would have worked well. Again, it just touched it there. But again, it could drop a lot lower. You'll notice the CCI is still dropping. So I'll leave that in there for the moment with that wider Fibonacci range. But again, the CCI is still dropping, and that hasn't quite broken through that resistance. On the micro level, the 1 hour chart, we look at the daily. So at the moment, you'd be predominantly getting ready to go short. I'll be hanging off at the moment. Don't go long or short until we see a more decisive move. You would have been probably taking a short position there, or that would have been a false break. I'd like to see these moving averages bend down, which they're starting to do now. So if that breaks to the downside, and so does the CCI, then start taking short positions. Back here on the 1 hour time frame, we work backwards. At the moment, we've got a bearish divergence, and it's pulled back already, started to play. Has it hit its target? Yes, it has. That's at 23-38% range. So it's already hit the target. Looks like it's bouncing, but again, notice the CCI is still dropping. Always pay attention to the CCI. That price can keep rising, of course. So long as the CCI keeps falling, we're going to consider that a bearish divergence. Back here, we had a bullish divergence versus the price that bounced. Again, depends where you took it. That would have been back to one of these peaks, but most likely that high there. You can see there it broke beyond a 61% Fibonacci range. In terms of the back tests, we started back here on the daily based when the price and the CCI broke above the moving averages. Now this is a tricky one because of this bearish divergence. You could keep it in play so long as the price remains above the moving averages. The stop loss approach here is generated about $543, and the average down is generated about $3,990. We averaged down a few times there, and a bit of a drawdown. But again, notice if you're trading again using our strategy, be mindful of the daily trend, but also you can also manage it with the hourly trend as well. So as soon as you see these bearish divergence, if you're going long, you want to get out of the trade at that point there. You see that when it starts breaking down after that bearish divergence, at that point, you would have got out before that drawdown started on that point there. Back here as well, you see a bearish divergence. You probably would have got out of the trade at that point there. And the CCI and the price started dropping off, and you would have avoided that drawdown as well. This is the British pound US. So on the monthly, bullish momentum above the moving average of both the CCI and the price. And there's no divergence currently. On the weekly, it's actually broken below the moving average of the CCI, so avoid taking long trades until that breaks higher. You'll notice the price is also weakening slightly, but always follow the CCI movement as well in terms of direction. At the moment, stand clear based on the weekly trend if you're trading on the daily. Back here, there was no divergence that I could see more recently. On the daily, we do have a bearish divergence, lower highs on the CCI versus higher highs on the price, and that's already started to pull back. The CCI is still dropping. So let's zoom in for a moment and see, take it back. So if we draw it back to the immediate low at that point, it's already hitting that 23-38% range. If we take it back to the significant low, it's actually touched that range as well. So I'll mark it at the significant low. Again, depending on how conservative you are, you can see it's already hit that 23 at the significant low there. But even if you took it back to, as I said, to that level there, it broke and bounced off that 38% level. So it's broken easily through that 23-38%. I don't trade these, again, I'll repeat that. I use them as a potential exit if I'm going long in this case. As soon as I start seeing a bearish divergence, I get out of the trade. So at the moment, bearish, and it's still bearish on the daily. If we go to the 1 hour chart, you can see here, that also gave you a micro view on the 1 hour to get out of the long trade if you're trading on the daily. You can see there it's broken below based on that bearish divergence, and that's actually broken down. If we measure a Fibonacci, below the 61% level. We had a bullish divergence back here, higher lows versus lower lows on the price, and that bounced. And this one bounced. I like doing these exercises to see an idea where it bounced to. Hit around about the 50% retrace level. So on the back test, this goes back to around this area on the 1 hour chart. The stop loss approach has been going pretty much sideways in terms of profitability. And again, you would have been paying attention to any bearish divergence, and you had quite a few there on the 1 hour chart. I didn't draw it, but you can see there going back to that level. You had a bearish divergence, and that would have avoided that little bit of a drawdown. Going back here, I won't draw them all, but I've already covered those ones there. And that one there, you would have avoided that drawdown with the latest one we've shown there. And even when you started going long during that period, as I said, you would have got out of the trade near the high there with profitability. But if you let it run through the whole period, and I'm not suggesting you do that, the stop loss approach is generated about $18.81, and the average down is generated about $27,000. Lastly but not leastly, the US Japanese yen. So you can see there it's been a nice big bull run, but we've currently got a very long-term bearish divergence. Hit this resistance up here at 161.95, and the price has been pulling back. It's actually broken below the moving average range, and the CCI is also still declining. So bearish momentum at the moment on the long-term US Japanese, and that divergence started back in late 2022. So these divergences can happen at any time period. On the weekly, we've got another bearish divergence here. You can see that's also pulled back. Looks like it's still in play. There's still a bearish momentum, although it's on the weekly, it's just broken above the moving averages. So it could be a start of a retrace, but again, could be just something like similar to that period back there. We don't know yet, but you can trade on the lower time frames based going long on that period alone. On the daily, and I'm just looking for any divergence. No, there was a bearish divergence back there, as I said, and that's pulled back. On the daily, first thing we look at is the trend, and at the moment it's neutral. Avoid going long until you see the CCI break higher, and the price is already broken above the moving average. So just wait for that break, the fresh break on the CCI, to start taking long trades. And just looking for any divergence. None that I can see there at the moment, so that's all good. Go to the 1 hour time period. Let's look at the naked chart first. So again, taking long trades from around the 1st of May. And what we look for is any divergence working backwards. You can see there we had a bullish divergence. So if you're going long during that period, that would have been a nice little area to go long, and taking a long position on that candle there, and you would have done quite nicely closing out your position on that little candle there. That would have been a nice little trade. Then a re-enter going long again there and closing it out again once that CCI touches that moving average range on one of those candles there. So taking those little gaps, or those little profits. Moving back, we had a small, very narrow bearish divergence. These narrow ones, by the way, have a lot more volatile price movement, so always be aware of that. And back here we had another bearish divergence and a pullback. Now looking at the back test, the stop loss approach has done okay. Now this, I had to increase the revenue for each of these on the back test to millions, because their revenue is in yen. So this one's generated 0.9 million, just under $1 million yen in terms of revenue. This one's generated 6.7 million yen in revenue. Again, you would have avoided that. Actually, could you have avoided that? No, at this point. Let me look at the daily. As soon as you see that, at the very latest, you should get out of the trade. You see there on the daily when it touches the moving averages on the CCI, on that candle there, that's where you get out of the trade. So always follow the daily or the higher time frame trends, and if it touches the moving average, you stop trading or close out your positions. So you would have got out of the profit level at probably holding 1 or 2 contracts at that point. At that level there, you would have avoided that drawdown. In this case, you didn't have any bearish divergence to help you. In fact, you did actually. I apologize. You did. You had a bearish divergence there. So as soon as you see that new high on the price, but a lower high on the CCI, you start seeing that price retrace back from that moving average. Actually, you wouldn't have entered that position there, because that would have given you an early warning, and you would have stopped out at that position there with both the stop loss and the average down approach. So you would have avoided that decline on the going long. This one back here, let's have a look. There was no, let me just zoom in a bit. Again, you would have closed out your position on the hourly based on that period back there. And then back here, we had another bearish divergence. And back here as well, with that bearish divergence, you would have got out of the trade at that point there and avoided this drawdown as well. So always pay attention to the lower time frame on both a lower and a higher time frame for divergence to exit any trades if it starts going against you. Again, reference the +1 videos to understand better the strategies used. Thanks for watching, and we'll see you on our next update.